Breaking news. General Motors just sent shockwaves through the entire auto industry. In a move no one saw coming, GM has slashed prices across its lineup. And we're not talking small discounts. We're talking massive price drops that could flip the entire market on its head. What's behind this sudden shakeup? Are they panicking, playing 4D chess, or preparing for a total industry reset? Stay tuned, because what's happening right now could change how and when you buy your next car forever. The sudden price plunge, how GM's shocking move caught everyone off guard. In a move that blindsided industry analysts, competitors, and even many within its own dealer network, General Motors has abruptly slashed prices across several of its most popular models, sending shockwaves through the automotive world. Overnight, vehicles that were once tens of thousands of dollars above market comfort zones are now being offered at prices not seen in nearly a decade. From the Chevy Silverado to the Cadillac Lyriq, markdowns ranging from $3,000 to over $10,000 have stunned both customers and competitors alike. For many, the first reaction was disbelief. Was this a limited-time rebate, a regional promotion, or some kind of mistake? But the reality soon became clear. This was no glitch in the system. GM had just pulled the pin on a pricing grenade that could reshape the entire auto industry. The timing couldn't be more surprising. Just months ago, GM executives were boasting about strong quarterly earnings and resilience in the face of inflation and supply chain chaos. Meanwhile, buyers have become accustomed to inflated vehicle prices, sky-high dealer markups, and long wait lists. So why drop a bombshell now? Some insiders suggest this is GM's aggressive attempt to claw back market share loss to rising electric vehicle, EV, competitors, and surging import from Asia. Others believe it's a strategic shift to force legacy automakers like Ford and Stellantis into uncomfortable territory, a full-blown price war during a time of economic uncertainty. Whatever the motive, the execution was swift and ruthless. Perhaps most shocking was the secrecy surrounding the move. There were no major leaks, no telegraphed warnings through Wall Street analysts, and no soft rollouts. Dealerships were reportedly informed just days, or even hours, before the public announcement. Some dealers were caught flat-footed, unsure how to manage inventory purchased at pre-drop prices. Customers who had just driven off the lot days earlier are now finding their vehicles worth thousands less than what they paid. And still, the phones haven't stopped ringing. Consumers are flocking to dealerships, hoping to capitalize on what many are calling a once-in-a-generation opportunity to buy new cars at used car prices. As headlines swirl and panic begins to ripple through the competition, one thing is clear. GM didn't just lower prices. They launched a calculated assault on the very foundation of auto pricing in America. The question now isn't just why they did it, but what comes next and who will survive the fallout. Inside GM's strategy, desperation, domination, or disruption, what comes next might very well define the future of General Motors and possibly the entire auto industry. The aggressive price cuts have left analysts scrambling for answers. Is this a sign of desperation, with GM trying to clear bloated inventories and salvage slowing EV sales? Or is it a cold, calculated power play designed to dominate market share and leave rivals bleeding? At the heart of GM's strategy lies a convergence of growing pressures. Their bold electric vehicle push, including massive investments in Ultium battery technology, has yet to yield the widespread consumer adoption they projected. Production costs for EVs remain high, and demand, while growing, is slowing compared to the initial surge. GM, once seen as slow to pivot, is now betting everything on volume over margins, essentially sacrificing short-term profits to secure long-term dominance. It's a gamble that could either catapult them to the top of the EV race or drown them in red ink. But there's another layer to this move that's even more telling. With Chinese automakers like BYD and NIO preparing for a serious push into North America, and Tesla continuing to slash prices on its own models, GM is likely trying to get ahead of a pricing collapse before it's forced into it. By initiating the drop themselves, GM controls the narrative. They position themselves as the value brand rather than the discounted one. This subtle distinction is crucial. It's the difference between leading an industry shift and reacting to one. Additionally, this price bomb may be aimed directly at legacy rivals. Ford, which has struggled with rising production costs and high sticker prices for its F-150 Lightning and Mustang Mach-E, now faces immense pressure to follow suit or risk losing customers en masse. Stellantis, heavily reliant on gas-powered Jeep and Ram sales, is now staring down a rapidly shifting market dynamic that may leave them flat-footed. GM's strategy, then, may not be desperation at all. It might be disruption by design, a bold attempt to force a realignment of the entire automotive pricing ecosystem on their terms. Internally, this move could also signal a shift in GM's approach to dealers and supply chain control. If prices continue to drop and demand surges, GM gains leverage to push its direct-to-consumer ambitions, streamlining distribution and reducing reliance on third-party dealers. It's no coincidence that this pricing bomb coincides with rising tensions between automakers and dealerships over transparency, markups, and EV handling. In essence, GM didn't just throw a wrench in the system. They threw a blueprint. Whether it's a last-ditch effort to stay relevant or a visionary roadmap to reshape automotive commerce, one thing is certain: GM has changed the game, and the rest of the industry is now playing catch-up. GM's price drop didn't just send shockwaves through its own corporate structure. It triggered a chain reaction that's now rocking the foundations of its biggest rivals. Within 48 hours of the announcement, Ford executives held emergency meetings to evaluate pricing structures across their lineup. The Blue Oval is in a particularly tight spot, with the F-150 Lightning already under scrutiny for high costs and delivery delays, and the Mustang Mach-E losing ground to cheaper EV alternatives. GM's pricing move puts Ford in a bind. Matching GM's cuts could mean billions in lost revenue. Not matching them could mean losing thousands of potential customers. It's a lose-lose situation, and GM knows it. Toyota, on the other hand, has spent decades cultivating a reputation for reliability, consistency, and value. But even they aren't immune to a pricing war. While Toyota's hybrid dominance remains intact, their sluggish EV rollout and reliance on traditional sedan and SUV models make them vulnerable in a rapidly electrifying, price-sensitive market. GM's move essentially hijacks Toyota's long-held position as the value leader in the eyes of consumers. In response, Toyota may be forced to fast-track incentives, update trim packages, or delay new model rollouts just to remain competitive. Quietly, insiders say Toyota is already reevaluating its North American strategy for 2025. Then there's Tesla, the wild card in this high-stakes game. Elon Musk's company has already engaged in its own pricing gymnastics throughout the past year, cutting and raising prices multiple times to stay ahead of rivals. But GM's bombshell adds a new level of complexity. Suddenly, legacy automakers are no longer selling EVs at luxury prices. They're now offering competitive, mainstream alternatives at shockingly affordable rates. Tesla, once the only name in the electric game, is now facing direct competition from the very brands it once dismissed as slow-moving dinosaurs. And with GM offering robust infrastructure, dealership networks, and government-friendly manufacturing strategies, Tesla's direct-to-consumer model starts to look less revolutionary and more isolating. Suppliers and dealers are also caught in the crossfire. Ford and Stellantis dealerships are already reporting canceled pre-orders and customer hesitations, as buyers wait to see if similar price drops are coming. Third-party parts manufacturers, especially those tied to higher-end trims and luxury models, are bracing for reduced demand. Even used car dealers are feeling the pain. Plummeting new car prices are rapidly devaluing late-model trade-ins, disrupting a market that had only recently stabilized after the pandemic surge. Ultimately, GM didn't just alter its own trajectory. It destabilized the fragile equilibrium that has kept its competitors afloat. In an industry where every cent of margin matters, this forced recalibration is a nightmare scenario for rivals. Automakers must now choose: follow GM down the rabbit hole and risk profit collapse, or hold the line and watch customers vanish. Either way, GM has taken the wheel, and everyone else is being forced to follow their lead. To the average car buyer, GM's massive price cuts look like a dream come true. For the first time in years, new vehicles, especially trucks, SUVs, and electric models, are suddenly within reach for families who were previously priced out of the market. Headlines are calling it the deal of the decade, and in many ways, they're right. Imagine walking into a dealership and saving $7,000 to $10,000 on a vehicle that was full price just days before. Financing deals are being sweetened, down payments are shrinking, and GM is even offering loyalty incentives on top of the cuts. It's a buyer's paradise, at least on the surface. But behind these jaw-dropping deals lies a more complex and potentially troubling reality. These aren't normal end-of-year clearances or model sell-offs. This is a coordinated, system-wide reset of GM's pricing philosophy, and it could have long-term implications for every car owner in the country. The most immediate impact? Depreciation. Customers who bought a GM vehicle even a few weeks before the price drop now find themselves holding a product worth thousands less overnight. That's not just frustrating, it's financially destabilizing. Trade-in values are collapsing, lease residuals are being recalculated, and resale markets are being flooded with uncertainty. For those considering a purchase, the big question is, why now? Are the discounts a sign of market generosity, or are they a red flag of a larger industry correction? If GM is cutting prices this aggressively, does it mean they overproduced? Are inventories piling up? Is demand weakening? Many experts warn that while the current deals are real, they could signal a deeper problem in the market, especially for electric vehicles. If EV sales are slowing and GM is slashing prices to artificially boost numbers, consumers may be stepping into a volatile market where warranties, parts, and resale value could suffer down the road. Then there's the risk of a race to the bottom. If competitors like Ford, Hyundai, or Tesla feel forced to follow GM's lead, the entire market could tip into an unsustainable pricing war. That may benefit buyers today, but it could destroy dealer networks, shrink service support, and delay future vehicle development as automakers scramble to protect cash flow. Cheap cars today might mean fewer options, less innovation, and higher costs for maintenance tomorrow. Yet despite these risks, consumers are voting with their wallets, and fast. Dealerships report skyrocketing foot traffic, online inquiries are surging, and some GM models are already facing fresh waitlists just days after the announcement. For buyers with the right timing and financing, this is a golden window of opportunity. But savvy shoppers are being warned. Read the fine print. Check model year details. Watch for stripped-down trims or changes in features that may be hidden behind the headline price. In the end, GM's price drop is a double-edged sword for consumers. Yes, it brings affordability back to a bloated market, but it also raises uncomfortable questions about the stability of vehicle values and the direction of the industry as a whole. Whether this moment becomes remembered as the best time to buy a car in a generation, or the beginning of a downward spiral, depends on what comes next. And right now, even the experts don't know where this road leads. The future of the auto market. Is this the beginning of an industry-wide price war? General Motors may have lit the fuse, but what's unfolding now looks less like a one-off price adjustment and more like the opening salvo in a full-blown industry price war. Across boardrooms and manufacturing plants, automakers are scrambling to assess what comes next. Can they afford to match GM's drastic cuts? Can they afford not to? The auto market, already battered by inflation, interest rate hikes, and fluctuating demand, is teetering on the edge, and GM just gave it a push. Historically, price wars in the automotive industry have been brutal. They erode profit margins, strain supplier relationships, and often lead to rushed, risky decisions. Cut corners in manufacturing, reduced investment in innovation, and a collapse in customer service standards. If Ford, Toyota, Tesla, Hyundai, and others respond with comparable discounts, the result could be a market flooded with underpriced vehicles that look great in the showroom but carry unseen long-term costs. The race to the bottom rarely has winners. It leaves balance sheets bleeding, dealerships desperate, and consumers caught in the aftermath once the dust settles. But this isn't just about money, it's about power. GM's bold move was also a signal. They intend to lead, not follow, in a new era of auto sales defined by electrification, direct-to-consumer disruption, and tech-integrated vehicles. If their pricing gamble succeeds, it will force every other automaker to confront an uncomfortable truth. The old way of doing business is dying. Sticker shock is no longer sustainable. Sky-high MSRPs backed by questionable dealer markups are being exposed for what they are, barriers to progress. The electric vehicle segment is especially vulnerable. EVs are still perceived as premium products, with price tags that reflect high production costs and luxury aspirations. But if GM is willing to price its EVs like mid-range gas cars, the competitive landscape shifts overnight. Suddenly, a family considering a Toyota RAV4 hybrid or a Ford Escape may find themselves leaning toward a Chevy Blazer EV, not because it's greener, but because it's cheaper, and that, more than anything, could force the next generation of vehicles to be priced on utility and accessibility rather than hype and exclusivity. There's also the role of global markets to consider. Chinese automakers, long locked out of the U.S. market by regulatory and political barriers, are eyeing entry with inexpensive EVs that could undercut even GM's new pricing model. If a price war breaks out before they arrive, they may find themselves walking into a battlefield already scorched by collapsing margins and cutthroat competition. For American automakers, GM's preemptive strike could be a defensive measure to soften the ground before foreign invaders enter the fray. So, is this the beginning of an industry-wide price war? All signs point to yes, and the implications are massive. It won't just change how vehicles are priced. It will change who survives in the next era of auto manufacturing. Legacy giants may fall, unexpected players may rise, and consumers may finally see affordability return. But at what cost to quality, stability, and innovation? GM has fired the first shot. Now, the rest of the auto world must decide whether to retaliate or risk being left behind in a market that's transforming faster than ever before. While the public sees flashy headlines and slash prices, what happened behind the scenes at General Motors tells a much deeper and far more dramatic story. This wasn't just a bold marketing move or a visionary pricing strategy. It was a result of intense internal pressure building for months, possibly years, as GM faced mounting challenges from every direction. Lagging EV adoption, skyrocketing production costs, stagnant dealership sales, and a rapidly changing global market. When the price cuts finally went public, it wasn't just a shock to the world. It was the breaking point of a storm brewing inside GM's executive halls. Sources close to the company reveal that GM had been quietly grappling with a crisis of confidence. Despite bold public statements about EV dominance and innovation, internal reports showed growing inventory backlogs, especially in electric models like the Chevy Blazer EV and the Cadillac Lyriq. Dealers were sounding alarms about low showroom traffic and hesitant buyers. Consumers, burdened by rising interest rates and economic uncertainty, were simply unwilling to pay the premium prices GM had attached to its new tech-heavy vehicles. The excitement around electric mobility was fading fast, and GM's financial projections were beginning to unravel. The boardroom response was fierce. Senior executives and strategists reportedly debated for weeks over how to respond to the weakening demand. Should they scale back production, delay new launches, or do the unthinkable, cut prices and risk sparking chaos across the market? Insiders say the tension reached a boiling point in late May 2025 when several key investor groups began pressing GM leadership for a clearer plan to reignite growth. Stockholders were losing patience, and confidence in CEO Mary Barra's long-term vision was starting to crack. Something drastic had to be done, and fast. The pressure wasn't just coming from the outside. Internally, GM's EV division was facing escalating costs due to battery supply chain constraints, software development delays, and quality control issues. The much-touted Ultium platform, while promising in theory, was reportedly still struggling to deliver at the scale GM had projected. Engineers were under pressure to meet aggressive timelines, and some plants were operating below capacity despite massive investments. It became increasingly clear that the only way to jumpstart momentum, and buy time, was to make their products more financially irresistible to consumers. The decision was made swiftly and with surgical precision. Rather than ease into discounts or offer dealer-specific incentives, GM leadership chose to go nuclear, dropping prices across multiple models across the board without warning. This would not only jolt the market, but also demonstrate to shareholders that the company was willing to fight tooth and nail to maintain relevance and market share. It was a high-stakes maneuver that could either restore confidence or destroy it completely. And while the public reels from the shock, behind GM's polished press releases lies a simple truth. This was a survival move. The auto giant found itself at a crossroads, caught between its past as a traditional automaker and its future as a tech-driven EV pioneer. Backed into a corner by internal and external pressure, GM chose to punch its way out. Now, as the rest of the industry tries to catch its breath, the question is no longer why GM did it, but how long they can keep this up before the pressure builds all over again. When General Motors detonated its pricing bomb, the tremors were felt far beyond the factory floor or dealership lots. They hit Wall Street like a lightning strike. Investors, analysts, and financial institutions scrambled to make sense of the sudden, aggressive move. Was this a moment of brilliance or a sign of impending collapse? Within hours of the announcement, GM stock experienced massive volatility, initially dipping as uncertainty rippled through the markets, then surging on hopes that the company had taken a bold, competitive leap ahead of its rivals. But as the dust settles, one thing is clear. This isn't just a marketing strategy. It's a message to the financial world. GM is not playing defense anymore. It's going to war. For years, Wall Street has been deeply skeptical of legacy automakers' ability to transition into the electric future. While Tesla soared on innovation and tech buzz, companies like GM were seen as lumbering giants, weighed down by outdated infrastructure, union negotiations, and complex dealer networks. This price drop flips the script. By sacrificing short-term profits for massive volume potential, GM is signaling that it's ready to play the long game, and it's willing to take hits now to win later. That kind of aggressive forward thinking has caught the attention of hedge funds and long-term institutional investors who see potential for explosive market share gains. But the move has also rattled nerves. Financial analysts are now questioning GM's cash flow resilience. With profit margins expected to shrink significantly, how long can GM sustain this strategy without burning through capital reserves? Will its Q2 and Q3 earnings reports show a spike in sales, but a crater in revenue? How will that impact stockholder returns, dividend payouts, and R&D investment? Credit rating agencies are reportedly reviewing GM's financial outlook in light of the aggressive discounting, and bond markets are already seeing fluctuations in automotive debt pricing. Meanwhile, GM's rivals are facing their own investor firestorms. Ford's share price took an immediate hit as speculation mounted that it would be forced to match GM's cuts or risk losing significant market share. Tesla's valuation, already volatile, is under new scrutiny as analysts debate whether Elon Musk's company can maintain premium pricing in an increasingly price-sensitive environment. Even Toyota, once considered a safe bet for investors, saw hesitation among U.S. market stakeholders. In short, GM's move didn't just shake the auto industry. It sent ripples through the global financial ecosystem. What's perhaps most fascinating is how the narrative is beginning to shift. For over a decade, the automotive story on Wall Street has been about disruption from the outside, startups, tech firms, and EV-first companies eating into legacy giants. But with this single move, GM may have reversed that logic. Now, it's the legacy automaker doing the disrupting, forcing newer players and traditional rivals alike to react. Whether GM's stock stabilizes or slides will largely depend on what happens next. If sales explode, investor confidence may grow stronger than ever. If the move backfires, creating losses without the volume to justify it, Wall Street could turn brutal. But one thing is undeniable. GM has just redefined the risk-reward profile of the entire auto sector. And in doing so, it has reignited the attention of every serious investor watching the future of mobility unfold.